Hello everyone, myself Yamatullah Hanif Mullaji. I am assistant professor in ICS College Head. Today we are here for Techno-Crunch course and my today's topic name is Income Stream and Tax Saving Scheme. Let's see what is mean by income stream and tax saving scheme help for presentation. So for my topic name is income stream and tax saving scheme. Let's see first investment. Investment can stock, bonds, mutual fund, interest bearing account, land, derivative, real estate, and old comic books, jewelry, anything of invest, believe in produce or income. Usually from the income from the interest rate and become a worth more. The most of types of investment comes on risks also come. So first of all, capital risks. Whatever they invest, voluntary of over them, always be risks of capital. Value may be fall of individual need to be aware before making such investment as their risks and capital involved. Some market risks. There are various market factors that affected equity risks. It is a risk applies to the investment in share since the demand and the supply may be lead to drop of the market price of share. Next, interest rate risks. Interest rate risks also losing money due to changes interest rates debt instrument. For example, interest rate also low and the market value of bonds and increase. Currency risks. It is the risk of long losing money due to currency fluctuated. For example, if the current value of INR less as compared to USD, United States dollar, Indian stock will be worth less rupees undercome of United States dollar. After that, liquidity risks. Liquidity risks being unable sale of investment at the fair of price, not getting the money of when as liquidity risks. Next point, what is a tax? The tax is our income which the government of India take from us, providing facility like water, drainage system, infrastructure, and protection from enemy through our army, navy, and air forces. Tax is a major sources of revenue for the government. After that, the two types of tax are come: direct tax and indirect tax. Direct tax is one which is borne has to be paid by the taxpayer himself. For example, income tax. After that is a tax due of person, income and wealth payable directly to the government. After that, some example: wealth tax, income tax, and property tax. These types of all example of direct tax. After that, second point, indirect tax. Indirect tax due on a person who consume the goods and services and indirectly paid to the government. The burden of the tax comes shifted to the one person to the another person. Some examples are central tax, value-added tax, excise duty, and custom duty. These are types of indirect tax. After that, pension system in India in different three pillar. Pillar 1 funded by the government, pillar 2 funded by the employee, and pillar 3 funded by the citizens. Next part, pension. A pension scheme saving plan to help save money from later life. Pension plan provide financial security and stability during old age when people don't have regular sources of income. Retirement plan ensure that they are with the amounting of the lifestyle during their advancing of the years. A long-term saving plan makes sense put of some money from away from you when you are young and make it available for your old age. After that, some pension scheme in providing for pension plan, public provident fund. Public provident fund is saving cum tax saving instrument in India. The aim of this scheme to the mobilize of small saving, offering of investment with the responsible return of combined income tax benefit. The PPF Public Provident Fund scheme serve to be of the most benefit investment option of both salaried people and the employed. The benefit of this period, the giving 15 years and the interest rate 8.70. After that providing the minimum amount in deposit in public provident fund 500 and the maximum amount at the public provident fund to pay 1,50,000. After that, the most important part in public provident fund, the providing tax benefit. Next point, employee provident fund. Employee Provident Fund is a retirement benefit applicable only to salary employee. It is fund which both employee and employer contribute 12% of the employee basis salary of each month. The percentage present by the government, the Employee Provident Fund, administrated of the employee, and Provident Fund organized a statutory body by the Government of India under the Ministry of Labour Employment. It is a form of advisory members and contribution of Provident Fund scheme both of employee and the employees. After that, an employee cannot withdraw an employee provident fund before attaining the age of retirement, and the retirement has been increased 57 years into 58-year old age. However, the employee withdraw up to 90% amount of the our age of retiring 57 years. Next point, general provident fund. General Provident Fund account provide fund account is available of the government employee. A government employee can become a member of the fund by the contributing certain percentage their salary to their account. The accounting of the fund paid to the government and employee of the time of the retirement. Only government employees are eligible offering general provident fund account, and employee working with the private company are eligible for this account. The money from fund will be given by the employee when they are retired. After that, the General Provident Fund features known as general advances, which has the interest free and the loan of the general provident fund saving of the account of the attribute of the bank, and the regulated by the installment of the interest changes of general provident fund in advance taken once of the general advances next on their investor. Next point, new pension scheme. The new pension scheme is regulated by the pension fund and the India age 18 to 60 years and participate. It is the extremely cost effective fund management are low. In this scheme, the individual may contribute his account over the year. The amounts of contributed investment your chosen fund manager of the invest to the equity, debenture and bonds, etc. After that, employee pension scheme. Employee pension scheme is a scheme from survival old age or disabled person. The scheme can infected by the 16 November started on the effective 16 November in 1995. After that, the pension amount of scheme of the providing contribution of rather services period of tax decision monthly pension given by employee pension scheme in India. After that, ULIP pension scheme. ULIP pension scheme have various options, allow individual to select the most suitable from interest of investor with the high risk applicable from the equity plan, where the low risk and invest can be option. Income plan of medium risk of investor can be selected of the balancing plan. After that, mutual fund pension plan. Mutual fund also have started offering pension plan which are hybrid nature and having investment in the both debt and equity component. Mutual fund plan collect money from survival investments and the period of money and equity debt and market. Withdraw of fund discounted before your retirement standard retirement is taken from 58 years. After that, the post retirement can be invest make a lump sum withdrawal of opposite regulate income. So next point, pre and post retirement strategy. What is the use of pre and post retirement strategy? Retirement planning in our complex tasks, rising inflation, slow economic growth, low and gold availability to the many financial product make the new life complex of the individual. Some of the pre-retirement strategies. New pension scheme. The new pension scheme is regulated by the pension fund, regulated by the development authority. After that, the amount which contribute invest by the your fund, the manager choose of your invest, and the fixed price of investment and the equity debenture and bond taking the good quality of return. After that, the total deduction allowed the scheme under ATC and ATCCD, the income tax 1961 cannot exceed 1.5 lakh. Next point, Employee Provident Fund. The Employee Provident Fund is administered by the Employee Provident Fund organized, which is the statutory body developed by the Government of India. It is retirement benefit which is applicable only salaried employee. Both employee and the employee contribute 12% of the employee basis salary of each month of the fund. Unemployed cannot withdraw Employee Provident Fund before attending the retirement of age up to 58 years. However, withdraw up to 90% of Employee Provident Fund allowed to attaining the age of 57 years. After that, currently Employee Provident Fund interest rate is 8.8% they provide in Employee Provident Fund. Next, Public Provident Fund. Public Provident Fund is a saving cum tax saving instrument in India, is one of the most benefit investment option for the both the salaried and self-employed people. The interest rate also provided the public provident fund same like 8.70 per annum. After that, it is a held of giving the period in public provident fund to 15 years. After providing interest earned in public provident fund is fully exempt for tax. The giving the good tax benefit in public provident fund also. Next point, equity. Equity share are one of the most financial instrument that they provide goods return for the long at least 10 years and more. However, does the mean that you have whole of this share even they are not performing well. Review the mutual fund and stock every year which the better products giving the in equities line of the mutual funds give us option systematic investment plan and equity related products are tax free after 1 year of investment. Next point, bonds and debenture. A debt or certificate issued by the company of acknowledging the debt and the acknowledges of the loan from invest by the company of the government gives some interest for loan. Investing funds debenture bond will be provide benefit for the investor of long run. Also the rating for the bonds and need to be review of before investing. Exchange trade fund. The investor can purchase unit of exchange trade fund purchasing gold units every month. It is a good option of accumulating complex of the retirement. It is benefit investor. It is available of bulk investing reducing the risks associated. Next point, some strategies at invest of the investors providing first point lifestyle. Start thinking about how your old spouse wish to spend their time retirement. Your lifestyle today and your aspiration tomorrow will be affected in your retirement plans. Finance. Start estimating retirement spending need to include tax retirement medical expenses. The the senior you have invest insure cover, the lower your permission will be held to taking financing facilities. After that, assets you have stand. Next point, so have you count your assets where you stand, ensure your mortgage paid within the suitable of the fixed time of period and the providing the best facility of this situation. Next, downsize your housing. If your retirement budget is limited, move a smaller place or less expensive neighborhood as maintenance change at tax rates are low. Invest and sell wisely since the market rates are always fluctuated and changes. Don't subsidize and your kids' lifestyle. It is rightly said that if your man is hungry, don't give him fish. Rather, they teach him how to make fish. Teach your children be financially independent to make them prepared on the future, so they can do anything when the problems are come. They take the solution of every time of period and take them various independent making the preparing of solution. Share alike, parents and children can be preferably share can some apartment along with the amenities and equivalent of the saving cost. Go international. Some American after retire return to their homeland, for example in India, where they enjoy support from family members. They relocate such countries where cost of living is low and relatively safe. Search out of entertainment, search out of free environment, and after that just check our low cost entertainment option like free libraries, free social cubes, subsidies, pensions, etc. Spend your leisure time at the title of cost. Next point, post-retirement investment strategy. First, monthly income scheme. Monthly income scheme (MIS) provide regular income to the investment. After that, the best example of the post office saving scheme, various mutual funds, etc. Next point, senior citizen scheme. Senior citizen schemes, sorry, senior citizen retirement scheme, which is the investor need of the retirement. It is the safest investment option of senior citizen. A senior citizen scheme amount can be opened a post office of many nationalized bank. Reserve mortgage. A reserve mortgage is an option to senior citizen a regular sources of income. You can pledge your house with the bank of receive regular income from the bank of given the period. The amount received will be depend on the valuation of the house and the term of the operated of the period. The income received from the house property under the scheme is a tax free. Next point, pension plan. A pension plan a pension plan provide by insurance companies as well as mutual fund. The investor can invest lump sum amount such as plans will be monthly income after the retirement. Next point, liquidity funds and fixed deposits. A senior citizen invest might to need put asset some amount of emergency. If you have any problem to take this amount of use of emergency period to make the sure this amount is unretained return. Investor can be opposite liquid funds, fixed deposit and different terms of period. You can use the amount liquid fund are tax effectively when we use. Next point, so our next point is income stream and tax saving scheme. The income stream, the Indian income tax allow for certain reduction that can be claimed to save tax at the time filing the tax return by classes of taxpayer, salaried, professional, and businessman, etc. Uh, this dedication for the saving tax are only available if the taxpayer has done proper planning during the year. If the individual has done proper tax planning to save tax, such deduction would be substituted by the gross total income and tax would be levied on balance income per income tax in force. After that, the various types of schemes are providing in income stream. The first point is public provident fund. The public provident fund (PPF) is saving cum tax saving instrument in India. The aim of this scheme is to mobilize small saving by offering an instrument with the reasonable returns for combined with the tax benefit. The providing the tax scheme serve to be one of the most beneficial investment option for salaried and employed people. After that, the second point, the pension fund. The pension fund, another from life insurance, they serve difference and objective from other insurance plan like plan and endowment plan. After that, the term plan is very important, and the which are called protect plan. The protection plan are great financial resources of individual family. His death of pension plan aim to provide for the individual of his family and lives on. After that, section 80cc stimulate that the investment protection fund and the eligible of deduction maximum deduction available of rupees 1.5 lakhs. After that, health insurance and mediclaim. Health insurance or mediclaim as is more popular income covers and the expenses incurred from accidental and hospitalization mediclaim also cover pre and post hospitalization expenses. Health insurance offer tax benefit under 80D, that is insurance premium rupees 20,000 taking the benefit of senior citizen 20,000 and 15,000 of other eligible of tax benefit. After that, new pension scheme. The new pension scheme is regulated by the Pension Fund Regulated and Development Authority and citizens of India 80 to 60 years and bracket the door age of the participant. It is extremely cost effective since fund management changes are low. After that, contribution made the national pension new pension scheme and covered under the section 80C and the income tax act. The aggregate limit of deduction under this section along with section 80C and 80CCD cannot be exceed the amount of rupees 1.5 lakh per annum. Next point, tax saving saving mutual funds. Tax saving mutual funds, quality for tax benefit. Tax saving mutual fund invest in a stock market and the more succeeded with the medium of high risk appreciate, and the investment in the tax saving mutual fund are located in the same years of period, the giving 15 years. After that, life insurance play the important role of individual of financial portfolio, offering security the individual family case of eventually the mix of the breadwinner or primary responsibility to take insurance at the earlier of the family security. Premium, after that, the get premium of towards life insurance are covered under the section 80C of Income Tax Act, maximum rupees 1.5 lakh of per annum, and taking the protection plan. Next point, tax saving of home loan. The understanding of tax benefit of home loan would be divided repayment of the home loan into two types of category. First, repayment of the period of amount and repayment of the interest of home loan. After that, the infrastructure bond security, the providing some eligible instrument section 80C, there are the issued of the companies approved of the government, they offer claim and the efficient plans of benefit. The efficient plan of benefit and the investment up to 20,000 at the bonds and eligible income, the tax deduction under section 80C. Next point, the Sukanya Samruddhi scheme. The Sukanya Samruddhi scheme is a tax saving scheme started for the child girl or girl child. It is open only for girls below 10 years. Sukanya Samruddhi scheme is a better option that the bank deposit and child plan etc. Account can be opened any post office and nationalized branches of personal of banks of minimum investment rupees 1000 and the maximum investment of financial year rupees 1.5 lakh of deposit can be made for 14 years after opening. The account of parent can be opened account of maximum for two daughters. After that, Rajiv Gandhi equity share scheme. The Rajiv Gandhi Equity Saving Scheme is the latest equity tax saving scheme available for equity investors in India with the role of purpose of motivating of small investor and invest their money in the domestic capital market. The maximum invest allow for the claiming of registration at rupees 50,000. The invest will be eligible to get 50% reduction of the amount. So if you invest 50,000, you will get tax deduction of only 25,000. Senior citizen scheme. Senior citizen savings scheme may be open of an individual who has attained the age of 55 years more than the last 60 years and has been returned under the voluntary retirement scheme. The maximum amount that can be invest their scheme is rupees 15 lakhs roll of interest 9.2 per annum. After that, no age limit for the retired person of the defense service of the provide default of other specified period. After that, tax planning for salaried employees, the house rent allowances. Employee generally relative of house rent allowances from their employee. This is part of salary package and with the income at the terms of good condition of the employment. After that, the next point, the travel allowance. The travel allowances, the leave travel allowance is paid to the employee as a part of travel within the country with or without the family. But leave travel allowance amount is a tax free under section 10(5) of the Income Tax Act. However, such exemption it is limited only the exempt of actual travel cost incurred of the convenience allowance is exempted to the start of rupees 1600 month and rupees 19,200 per annum under section 10H. Children education allowance. Children education allowance is also accepted from income tax. Fixed education allowance received from the employee is exempted from the price tax of extent rupees 100 per month and maximum for two children. allowance paid for hostel in exempt to the price of 300 per month of maximum for two children. After that, salary restructuring, there are components of your salary which can help which can help to save taxes. For example, offering for food coupon intent of lunch allowance can exempt tax of rupees 36,000 per annum. You can also choose take company car instead of your own car to reduce taxation, include medical and transport allowances, telephone and internet allowance, and education allowance to save the much tax as possible. After that, the tax saving home loan. Tax saving home loan, the principal amount of your home loan is also eligible for tax exemption under the section 80C, but here you can save up to rupees 1.5 lakh for the interest part of separately under section 24. So after that, life insurance, the mostly life insurance in the insurance in two types of insurance. The first of all, life insurance. The life insurance is for a contract under which is insured undertaken to pay for insure a certain amount money either on death of the insurer after expire on the contract. The types of life insurance are come first of all term plan policy. Term plan insure provide financial protection to the policyholder for a specific period of time. If the policyholder survives the term period, nothing is payable in case of his death. His, his beneficiary of entire of receive the sum. After that, endowment plan. Endowment plan, unlike term plan, endowment plan provide a sum along with the profit and the policyholder in the event of death and survival of the policyholder. And also once the contract is expired, however, the premium paid by the policyholder are also in high. After that, ULIP, unit linked insurance policy or plan. ULIP help the insured by the protecting him from the risk and also enable him of invest. However, the performance ULIP link of the market situation, the allocation of stock and debt market can be decided by the investor. After that, whole life insurance policy. The policyholder pays regular premium until the death and enjoy the life cover throughout his life. After that, the sum of the paid of his family. However, in case eventually unseen event, the policy expired. There no predetermined policy of in whole life policy plan. After that, money back policy. Here the insured get a protection from the insured regular investor if the policyholder survive the term and he the get balance sum which assurance in case of death beneficiary will get fully sum assured. After that, group life insurance plan. The group life insurance individual cover under the common life insurance policy. It is a very common corporates. And the most important part in life insurance, the pension plan. In pension plan are one of the most beneficial investment option that encourage an individual to save the creation amount of money of retirement of ensure safe future. After that, health insurance in the part of life insurance. Health insurance is an insurance product which cover medical and surgical expenses of insurer and individual expenses incurred due to injury illness for the insurer of individual. After that, it is a contract between the insurer and the individual group in which the insurer agreed to provide specified health insurance cover at the particular premium subject to the terms condition specified the policy. Increased life and rising cost of medicine healthcare expenses created by the need of health insurance policy. After that, the sum of injury may be individual basis of the flow of basic entire family. Next type of insurance, the general insurance. The general insurance cover insure of property against fire, theft, personal insurance, health, travel, accidental, etc. Unlike life insurance policy, the term of general insurance policy is not a lifetime. Some type of policy, general insurance policies, the type of life insurance, general insurance policy, fire insurance. Fire, fire leads to reduction of property, valuable and even life. A fire insurance policy protects the policyholder from the risks that occur due to the outbreak on fire. After that, motor insurance. Motor insurance protect your vehicle from any damage of theft that are caused of vehicle due to on-road and off-road emergencies. After that, motor insurance is mandatory compulsory in which per motor vehicle Act 1988 and needs to be reviewed every year. The third party insurance is statutory legal requirement in a country that owner vehicle is legal or the illegal of any injury or the providing dangerous cause third party property that arise because of the use of vehicle or public place. The next point in general insurance policy, travel insurance. The travel insurance, domestic and international travel involve risks like loss of baggage, loss of passport, theft and theft of luggage or medical emergency, etc. The protecting in travel insurance. This cover or provide travel insurance, also known as visitor insurance, protect the insured against unseen medical and non-medical emergencies during travel insure of hassle free of travel expenses. After that, home insurance. Home insurance is the most treasured protection and the largest financial investment of the individual. Home insurance protect from home from natural and man-made disaster like theft, flood, earthquake, etc. After that, marine and cargo insurance. The marine and cargo insurance movement of goods across national and international borders involve risks can lead to be damage of shipment, this leading to the financial losses. After that, the marine insurance cover the damage caused during the transit by the rail, road, sea and air. After that, if offer complete financial protection during the transaction to goods in the events of any loss. And the rural insurance, the part of rural insurance provide insurance solution to meet the needs of agriculture and rural businesses. The Insurance Regulatory Development Authority, the setup annual to the insurance company provide insurance services and rural social sector. After that, personal accidental insurance. This type of insurance protect from person or group person from any injury, disable cause of accidental or any other events. Person and personal accident insure provide 24-hour worldwide insurance protection. After that, commercial insurance. Commercial insurance provides insurance solution to the all sector of the industry like technology, telecom, manufacturing, aviation, chemical, food, etc. Some of the types of commercial insurance are property insurance, energy insurance, engineering insurance, fire insurance, theft insurance, and employee benefit insurance, etc. After that, the health insurance. Health insurance cover the medical and surgical expense of the insured due to hospitalization from an illness. Health insurance policy help to reduce the financial risks associated with the healthcare include cashless facility of certain hospital, pre and post hospitalization expense, ambulance charges, daily cash allowances, etc. After that, pension plans from insurance company are providing some functional of insurance. Insurance provide certainty. Uninsurance provide certainty to the insured by the protecting him against the risks of the losses that occur due to uncertainty. The losses will be compromised in this form of payment of the huge type of loss. In after that, insurance provide protection. Uninsured protect from any from risks and occur due to any uncertain. The main purpose of buy insurance cover protect the instant of hedging protection against all types of risks. Risks are uncertain and therefore the losses arising from them are uncertain. The losses are shared among of all persons who are exposed to the risk. After that, if a person not to get an insurance, he is responsible for all losses incurred with the might of incur in future. Their losses are come in future. If any case uncertainty of insurance company is legal to compromise to the losses incurred per action or per person of the insured. Next, so before we see pre and post retirement strategy, let's see what is meant by retirement planning. So retirement is a stage in the life cycle of individual when one stop being an active part of the productive working population on account of old age. So retirement planning refer to creating a financial plan for your ensure a secure future. After that, the life cycle planning. The life cycle financial planning help you to understand various types of financial risks that an individual come across his life and developing proper plan to meet those those changing needs which can be explained. So some of the pre-work start for beginning. So at this age an individual start his or her work life and it is not worried about the retirement years. During this stage, the individual is by with his business or employment and is financial independent. After that, the early working years, age between 25 years to 45 years. The early working years refer to period when an individual career is developing and it involves providing support to your family and managing burden like example loan. So after that, establishing an emergency fund, approximately 6 months of your income to be prepared from unexpected events like job loss, health-related expenses, etc. After that, prepare for unexpected issue related to health, life, and disability of insurance on early age. So that is something happen to you in your future. The financial burden won't be borne passed on your family member is managed properly. After that, start saving of retirement income. The sooner you start to save, the better it is, as create less pressure to save and seek high investment return in your later years. So our next point, the later working years between 45 years to 65 years. The later working years are characterized by helping children become financially independent, caring your parents, paying off your loans, etc. After that, the preparing of illness with the long-term care insurance as needed state tax planning or providing chronic or illness. After that, understanding how much we need the retirement saving you need to start. You have sufficient amount to generate living income in the future as paying off your liabilities. After that, the reviewing your sources of the retirement income by working on your social security plan and other income sources that can help you your retirement age. The consider purchasing as annuity that will be further increase the amount guaranteed lifetime income that your receiver. After that, after work of end age between 65 onwards, as your working years come on the end and your periods will be shift from saving to living of your saving, and this stage you will be need to decide when you stop working. The decision to stop working will be influence how long your saving will last, as the more number of year your work, the more will be your saving. After that, the maintain an income stream, maintain your retirement income stream, and this will be help you to manage and monitor the performance of your asset and the inflation rate that may be decrease your purchase power every year, and to ensure that your expense are not exceeding your plan. The plan for health and long-term care cost. The cost associated health care too much and significant amount to retirement saving is spent on the health, and the cost which be are covered by the government under a mediclaim or policy. After that, some factor affecting of wealth creation. So wealth creation refer to the accumulation of asset, especially those that generate income over a long period of time. So first point, the wealth creation are the investor objective. So what is the investor objective? Invest should be have clear objective about wealth creation and must focus on both wealth production and wealth creation. After that, the knowledge of investor. The knowledge of investor should have proper knowledge of where and how much to invest so that he can increase his wealth, and knowledge investor always aims for wealth creation. After that, market crisis. In the market crisis is such another factor that affect wealth creation. For example, if there are crises in USA, then an Indian investor cannot create wealth because it has direct impact on the market due to which the investor losses of his confidence. After that, economic outlook. Investors largely depend on the economic outlook like condition of the economy and performance of the economy, etc. While creating and wealth, if they see a positive economic performance, they will invest, which leads to wealth creation. After that, erratic cash flow. In the erratic cash flow, erratic means unpredictable. Investors do not get regular cash flow because they lack idea to carry out a business, which leads to improve wealth creation. The inflation rate has a direct impact on wealth creation as the prices of goods and the services increase. If the inflation rate is high, it would impact the real rate of return of investor and wealth vice versa. After that, our next point, interest rate. If the rate of interest on investment is high, the investor would be attracted to invest in the market, which leads to wealth creation and vice versa. After that, the other factor. In the other factor, the first are come the budgeting. Budgeting can be balanced your income and expenses, and this help to increase your net worth. After that, the next point is saving. The sooner you save, the better. It is for your future as maximum your net worth. After that, our next point, the ownership. In the ownership is referred to owners of asset, home, jewelry, etc. that add your saving, this creating maximum of wealth. After that, our next point is financial objective and retirement planning. Determine your retirement objective and goals is very important to ensure a secure future. There are four basic types of financial objective. The first is growth. The growth basically refer to an increase in the value of investment over a period of time. Growth or capital gain are the profit that an investor receive when he or she sell the capital asset like investment for a price which is higher than the purchase price. After that, the growth is approached for long-term and aggressive investors who are willing to undertake the risks involved in the stock market. After that, our next point, the income. Income is basically for those investment who seek a regular payout from their investment. Income basically include regular receipt in the form of interest and dividends. The instrument that provide a regular income include the debenture, both at certificate, deposit, treasury bills, etc. After that, the capital preservation. The capital preservation, the means safety. Every investor expect to receive his capital investment on maturity without any loss. This amplifying of our safety. After that, investment done with the government assurance more safety than the private sector, but the rate of the return will also low. Our next point, tax redemption. In the tax redemption, every investor desire to get benefit of tax expectations from the investors. Tax can be eat away a lot of wealth create, and the hence of sound like good knowledge of taxation required to reduce the burden of tax. After that, the sum available of the investment is the offer tax benefit of the time of initial deposit, investment that offer tax benefit at the time of maturity. So the last point, the sum of other object in the financial planning, the proper investment planning. by the proper allocation of asset in such as way that investors receive maximum return for the minimum risk. After that, insurance planning. In the insurance planning, the method of handling risks by getting the risk cover under an insurance policy to compensable for the losses. The estate planning. In the estate planning is necessary as the life expectancy on an individual is unpredictable and ensure that the risks and the right person will get the benefit of the corpus left like the our asset. After that, our next point, the retirement evaluation and planning. The retirement evaluation is the need of our and is very important to understand the factor that affect the retirement evaluation and planning ensure stable retire life like determine your risk tolerance. The risk tolerance is a physiological concept that refers to the level of risk that a client are comfortable with. The first step is to be determine your risk tolerance. After our next point, evaluation your package. In the evaluation our package, an investor must be understand the retirement plan offered by his employee towards any pension fund and the scheme to the know to how it works. Some of the points to be considered are like employee matching. The employee matching contribute is it match up to create 10% towards of your plan. After that, in investment option, various investment option can be considered. For example, an investor has a choice of taking 50% in equity and 50% debt when contributing to new pension scheme. After that, the fees charged by the fund manager also play an important role in the retirement planning and evaluation. Our next point, start early. The contributing of your retirement at an early age in late 20s, the life gets complicated over the year and houses kids again the parents and extra. After that, the compounding save each and every penny as the interest you earn of your retirement fund and each year is added to the original amount you are invest. After that, our next point is contribute. Regularly contribute towards your retirement plan. For example, contribute 2% at the age and 23. It should increase every year. Our next point, diversify of your portfolio. In diversify your portfolio, it is rightly said that the don't put all your eggs like investment in one basket and diversification of portfolio help to maintain a proper balance between the risks and return, thereby assuring stable return with minimum risk. Diversifying is an essential of the successful investment plan. At that time, considering diversification of your portfolio of investment planning, I would like to recommend it and show high return investment segment that is equity. The coronavirus in India current market fall can be best buying opportunity for investor. The world has suddenly become a different place in last few months with the coronavirus of COVID-19 taking host of nation by storm. The scenario changed, however, when totally anticipated the virus and the world WHO declared the COVID-19 pandemic followed by the various countries issuing travel ban, emergencies, lockdowns and other restrictions of capital market across the world. Even this pandemic situation, people had made money from share market. So to show the extent and true scenario of share market, I would like to share one share market, some stock specific research video. I hope you like to get the idea of investment strategy from this video.
Hello everyone, Rahul Sharma this side from Equity 99. My dear subscribers, my followers and my friends, a very great day to all of you and to your family. Welcome to our special video series. First of all, I would like to tell you that this is a very good opportunity which we are going to tell, as in terms of the cement sector, which we have already earlier recommended in our past, have made really good returns as of now, and we are still having faith in this cement sector. and today we are going to discuss about a stock which comes under cement sector. The name is Gujarat Siddhi Cement Limited. We have recommended GSCL earlier also at the rate of 26 and made good returns, and that stock reached at the levels of 34. Now we are again bullish on the same stock, which is GSCL Gujarat Siddhi Cement Limited. So this let me tell you something about this company first. This company belongs to Mehta Group. Mehta Group is a multi-activity, multidiscipline global enterprise spanning in four continents, that is Asia, Europe, North America, and Africa. The group business interests cover a wide and varied spectrum, which includes cement and building materials, packaging, sugar, horticulture, floriculture, engineering, electrical cables, consultancy, agrochemical, hospitality, entertainment sports, carbon dioxide, trade and financial sector, and international trade. The company is an ISO 9001 2015, ISO 14001 2015, and ISO 45001 in 2018 certified company, which manufactures ordinary Portland cement OPC, which is 53 grade, 43 grade, and Portland Pozzolana cement, which is called PPC, types of cement and clinkers. That company with world-class quality standards. GSCL is one of those companies in India, first cement companies to get 53 grade license. Gujarat Siddhi Cement Limited markets cements under the brand name of Siddhi. Its principal products are services are clinker and cement. Fundamentals of this company, if we'll discuss, equity of this company is around 87 crores. Total reserve with this company is 288 crores. And the good part is that the total borrowing of the company in the end of financial year 2019 was 53 crores, which has reduced in the end of financial year 2020 to 39 crores. So it's a very good point here. Book value of this company is near 43 and currently trading in the price book ratio of 0.70%. If we talk about March quarter numbers, in quarter 4 to financial year 2020, sales has increased from 156 crores to 165 crores. Operating profit of this company has increased from 8 crores to 26 crores. This is nearly around 3 times. Okay, and the net profit of the has increased from 5 cr to 16 cr. This is nearly about 3 times growth in the net profit. EPS is clocked to 1.86, and in financial year 2020 numbers have been very impressive. I'll tell you the sales numbers has increased from 563 crores to 585 crores. Operating profit has been negative in financial 2019, around negative of 11 crore rupees loss, which is now reported to 77 crores in profit. Company has posted net profit of which is actually loss of 6 crore rupees, which is now in 2020 reported a profit of rupees 45 crores. EPS, which has been clocked in 2000 financial year 2020, is 5.14. Now, this current stock is available at the low PE of 6x, which is very attractive right now for investment and availability at the undervalued rate. Last dividend was paid in 2013. Currently in financial year 2020, company has declared interim dividend of 10%. If you count this company, so this company has given around 33% if you compare this dividend to the rates of the company. And on each parameter, company is outstanding. The GSCL is perfect buy at this current stage. Entire cement sector have declared good numbers, and as soon the infrastructure activity increases, we also believe that these numbers in 2021 will be coming good. The rally, which has been very bullish in cement sector, will be continued, and buying opportunities from dips will be available in the market. So the company high price in 2018 was around 41 rupees, and all-time high was around 47 and 48. Now, when we are seeing this stock, now this good rally will be coming, crossing all the historical numbers like 47 and 48 rupees or 41 high in 2018. These all prices will be crossing in coming days, and investors having horizon of long term and want to invest in low price cheap stocks can make their position for good returns from the stock of Gujarat Cement Limited. So, friends, this was the complete information about this company, which the name is Gujarat Siddhi Cement Limited. Please be very cautious when you trade because currently market is very much volatile, and this is all what we want to say. Thank you so much. This was from Team Equity 99. Have a great day.
So this is investment strategy of Equity 99 showing how to invest in your future. After that, next point, reevaluate. In the reevaluate, the rebalance of your portfolio annually to make sure that you are investing your money as efficiently as possible. The after that, the re-exam your tolerance, the risks and reward, and accordingly to invest your bonds and stock. Thank you for joining. Stay home, stay safe. Thank you.